Welcome back to Breaking Down Personal Finance, where we make money make sense. If you've ever wondered how to build credit when you don't have any yet, you're not alone. It's kind of like being told you need experience to get a job, but you need a job to get experience. So how do you break into the credit world from zero? Credit is one of those financial tools that quietly shapes your adult life. It determines whether you can rent an apartment, how much interest you'll pay on a car loan, and sometimes even if you can get a cell phone plan without a deposit. But when you're starting out, it can feel like an exclusive club with no clear entrance. The good news is, there's a clear path. And it's not as complicated as it looks once you understand how credit works. Think of your credit history like a financial report card. Every time you borrow money and pay it back responsibly, you're earning good grades. Those grades get compiled into a credit score, a number that tells lenders how trustworthy you are with borrowed money. The higher your score, the more opportunities open up. But if you've never borrowed before, you don't have any data. No grades, no score. That's where building credit from scratch comes in. Here's the twist. Building credit isn't about borrowing a lot of money. It's about proving you can handle small amounts wisely and consistently. The system doesn't care how much you borrow. It cares how you behave when you do. Let's start with the foundation. Credit history is recorded by three main credit bureaus: Experian, Equifax, and TransUnion. They collect information from lenders about your accounts, payments, and balances. Then, credit scoring companies like Ficio or VantageScore crunch that data into a number between roughly 300 and 850. When you have no accounts, those bureaus have nothing to score. So your job is to create your first trackable activity. One of the easiest entry points is a secured credit card. This is a special type of credit card where you put down a refundable security deposit, often around $200 or $300, and that becomes your credit limit. You're basically lending yourself the money to prove you're responsible with it. You use it like a regular card. Buy gas, groceries, or small purchases, then pay it off in full each month. After a few months of consistent on-time payments, that activity gets reported to the credit bureaus and starts building your score. Here's where people get stuck. They think having a credit card means they need to carry a balance to build credit. That's a myth. The truth is, paying off your balance in full every month actually helps your score more than letting debt sit there. What matters most is that you use the card regularly and pay on time. If you're not ready for a secured card or don't qualify for one yet, another route is becoming an authorized user on someone else's credit card. Usually a parent, sibling, or close friend with good credit. When they add you to their account, the card's history can appear on your credit report, giving your score a head start. Of course, this only works if the main cardholder uses the card responsibly. If they miss payments or carry high balances, that can hurt your score too. So only do this with someone who treats credit carefully. Here's another clever starting point. Credit builder loans. These are small loans designed specifically for people with no credit. A lender, often a credit union or online bank, holds the loan amount in a locked savings account while you make monthly payments. Once you finish making all payments, you get the money back. It's like training wheels for your credit score. You're not borrowing money to spend. You're borrowing to prove consistency. Now, why does this consistency matter so much? Because your payment history is the single biggest factor in your credit score. It makes up about 35% of it. That means every on-time payment is like a gold star on your record. And every missed payment is a red flag. Even one late payment can stick around on your credit report for years. So, automation is your best friend here. Set up automatic payments or reminders to make sure you never miss a due date. The next major piece of your credit puzzle is called credit utilization. Basically, how much of your available credit you're using at any given time. Think of it like your credit card's breathing room. If your limit is $500 and you constantly spend $450, you're using 90% of your available credit. That tells lenders you might be stretched thin. But if you keep your usage below about 30%, ideally under 10%, It shows you're managing your borrowing comfortably. Here's a simple analogy. Your credit limit is like a runway for an airplane. You don't want to use up the entire runway every time you take off. Leaving space makes your takeoff smoother and safer. And lenders love that. Once you've got a few months of responsible use under your belt, you'll start to see your credit score appear. It might start modestly, maybe in the 600s. But with time, that number can grow dramatically. Patience is key here. Credit history length makes up about 15% of your score. So the longer you maintain good habits, the more solid your record becomes. Here's the part most beginners overlook. You can't just open a bunch of new accounts to speed things up. Every time you apply for credit, the lender does what's called a hard inquiry. That can temporarily lower your score a bit. It's like a small ding that says, "This person is seeking new credit." Too many inquiries in a short period can make you look risky. So, space out your applications and only open accounts you truly need. Another factor that shapes your score is your credit mix. This makes up about 10%. Lenders like to see that you can handle different kinds of credit. For example, both revolving credit like credit cards and installment credit like student loans or car payments. But don't rush to take on loans just for variety. It's better to have one or two well-managed accounts than a bunch of accounts you can't keep track of. Let's pause for a real-world example. Imagine two friends, Mia and Jordan. Both are 18 and starting from scratch. Mia gets a secured credit card, uses it for small purchases, and pays it off in full every month. Jordan skips credit cards altogether and just uses a debit card. A year later, Mia has a solid credit score in the high 600s. Jordan has no score at all. When they both try to lease apartments, Mia gets approved instantly with no deposit. Jordan is asked for a co-signer. Same income, same habits. But one built credit early, and it paid off. Here's the twist most people don't see coming. Good credit isn't just about borrowing. It's about opportunity. A strong credit score can save you thousands in interest over your lifetime. It can mean the difference between a 5% car loan and a 2.5% one. It can make insurance cheaper. It can even help you land a job in industries that check credit history. It's one of the few areas where small, consistent habits can quietly build huge financial freedom over time. As your credit grows, you'll eventually be offered higher limits or better cards with rewards. That's great. Just remember, higher limits don't mean permission to spend more. They simply give you more breathing room, which helps your utilization rate. Keep spending modestly. Keep paying in full. And let that positive history stack up. Now let's talk about what to avoid. The biggest mistakes beginners make are missing payments, maxing out cards, and closing old accounts too soon. When you close an old account, you lose its history. That can shorten your credit age and lower your score. So even if you don't use an old card very often, it can help to keep it open and use it occasionally for small purchases. Another trap is falling for quick credit fixes online. No legitimate company can erase accurate negative information from your report. Only time and good behavior can do that. But if you do spot errors, like a payment marked late when it wasn't, you can dispute it directly with the credit bureaus. Fixing mistakes can give your score a nice boost. Here's a fun metaphor. Building credit is like planting a tree. At first it feels slow, just a tiny sprout. But with consistent care, it grows roots and becomes something that supports you for decades. Skip the watering or neglect it, and it withers. But tend to it regularly, and it becomes financial shade when life gets hot. To recap, building credit from scratch is about starting small, staying consistent, and giving your history time to grow. A secured credit card, a credit builder loan, or becoming an authorized user can all open the door. From there, the key is simple. Pay on time, keep your balances low, and don't apply for too much credit too fast. Over time, those habits build a strong, trustworthy record that makes the financial world say, "Yep, we can count on this person." The best part? Once you've built that foundation, it keeps working for you. Whether it's buying a car, renting your first apartment, or getting approved for a mortgage someday, your early efforts will keep paying off in the form of lower interest, better terms, and more freedom. Before you head out, don't forget to like this video, subscribe to the channel, and turn on notifications so you don't miss future episodes. We're building a community of people who want to understand money without the boring jargon or judgment. And remember, don't take financial advice from someone drawing doodles on YouTube. Learn here, research more, and then make the call yourself. Thanks for watching Breaking Down Personal Finance, where we make money make sense. See you next time.